Okay, so still we need to refresh here. Good. We are looking at May 2016, question number 1, B Roman 1, and we're required to learn the project using the payback period. So we have 4 projects A to D, 4 project A to D, and if you look at the initial outlay the same, it cut across as 1 million, and we have the cash flow for each project. So we are going to look at the payback period. Payback period. So project A, if I look at the number of years, I have 3. This is 1, 2, 3. The cash flow, I have 500,000. 500,000, so you need to be there. And I don't have. Then I know my initial outlay. So cumulative, I can use this method, cumulative initial outlay. Cumulative initial outlay, which is this will be 500,000. And the other one is just 1 million. And if I add this one, it just give me automatic 1 million what I require. I just require 1 million. So automatic, I've just recovered my what? 1 million. But I've gotten that from the 2. So these are just 2 years. So the payback period is equal to 2 years. You got 2 years, that's cool. Okay. Go to project B. Project B. As for project B, still we have to look at the cash flow 2 and 3. That's the year. Cash flow. The first one, none. 650. 650, 850,000. 850,000. Cumulative cash flow. Cash flow. So here we don't have none, 650. So plus, if I add 850 to my 650, will it give me 1 million or more than 1 million? Will it give me 1 million or more than 1 million? You just say either 1 million or more. Nikiongeza, I'm just accumulating. It will give me more than 1 million. Therefore, I drop my 1 million and I put a curly what? A curly bracket here. So what is the remaining amount? Remaining amount, remember this is important. Remaining amount, ngapi? From your end. From your end. Remember, this is just simple, something to just remind ourselves, 350,000. So full year ni ngapi? Full year ni hii ya kwanza, sawa, ilikupatia to full sawa, but it was there. We spent for 1 year, 1 whole year without getting something. Then 2 years. So the payback period is equal to full year, which is 2, plus remaining amount, 350,000, divided by the cash flow, which has just given us that 850,000. To 1 decimal place, how many years? 1 decimal place. For 1 decimal period. 2.4 year. Thank you. Class, allow me to go to project number, project C. Project C. And I have the year as well. Cash flow. So year 1, 2, and 3. What is the cash flow for year 1? Tuko kwa project C. I'll add some ink kidogo. What is the cash flow for year 1? This one. Cash flow ni ngapi? Just check. Can just give me that. 300,000. 300,000. Year pili, the second one. The second one. The second one. Just tumalize hii. We move to something else. Yeah. 500,000. And the last one? The last one was 1 million. With 1 million? 1 million. Thank you. Asante sana. Good. Cumulative cash flow. Kuna 300 million, 1,000. Itakuwa 800 Bado sijapata my initial, so I have to drop my initial outlay. Remember, this is initial outlay, nimedrop. Curly bracket, remaining amount. How much is remaining? Is 200,000. 200,000. So in this case, the payback period is equal to, how many full years? 1, 2. 2 plus 200,000 divided by a million. This one. I'll be able to have 2.2. Yes. And the last one is project D. But before then, I would like you to confirm that we are together. Are we together up to that point? Please confirm. Confirm that we are together so that we move. Okay, good. Thank you. Project D, we have the year kama kawaida, miaka ni 3. Kama kawaida, 1, 2, 3. We have 3 years. Then the cash flow class. What is the cash flow for year 1? Year 1 ni ngapi? Just check from the question. Just check. Hii ni something tunamaliza 800,000. 800,000. Hii ingine ya pili ya tatu. Let's finish up. 400. Zote mbili 400,000. Hata hiyo ingine ni 400. Yes or no? Hata hiyo ingine. Is it 400? Okay, good. 400,000. Asante. So I have to come and check my cumulative cash flow hapa. Just accumulate. This is 800,000. If I add this one, it just surpass the 800. So I drop my million. And I put the curly bracket like that. Remaining amount, 200,000. 200,000. And to get the payback period, very simple. Payback period is equal to full year ni moja. Big one gave me this. Plus 200,000 over 400,000. That gives me 1.5. Yeah, so plus. Among the 4 projects, which is the best project? Thank you. And I like how you guys managed to do that. Which is the best, by the way? Among the 5. We say that the project with the shorter payback period is selected as the best. So when ranking, so we are going to rank them. So ranking. So you just type there, or write there, ranking. We want us to rank them. Ranking. Remember what we said when ranking these projects. In ranking, just say ranking. I know you did that. You guys are great. So to rank these projects, sasa ranking, because that's what the examiner wanted. Ranking. So when ranking, you have to write the project, the payback period, and then rank. You have project A, B, C, and D. Project A had 2 years. B had 2.4 years. This one, 2.2 years. This one had 1.5 years. So, as you've said, this rank number 1. Followed by this one. And the project B rank number 4. So the best project to be undertaken kwanza is project number D. That is it. Did you get that? How many got that? How many were able to do that? Although, how many? Just mention as we move to the next part. How many were able to mention that? How many were able to mention that? How many were able to do that? Okay. So at that moment, now you know how you're supposed to do. Is that true? Now you know. Sit up. Now you know. Let's look at the next part. Remember, we are under traditional techniques. This is now the second method under tradition, which is accounting rate of return. Counting rate of return. Counting rate of return. Okay, thank you. Thank you so much. So accounting rate of return, ARR. Remember, we are now winding up on the tradition. Thank you, Virginia. I can see Virginia about that. We also have units. That's very good. Asante. Thank you. So you say that it is a financial metric. It is a financial metric. Metric ni kitu ya kupima. It is a financial metric. It is a financial metric used to evaluate the profitability of an investment. Financial metric used to evaluate. Is a financial metric used to evaluate the profitability of an investment. The profitability of an investment. Used to evaluate the profitability of an investment. Good. Full stop. Then you say that it measures the average annual accounting profit. It measures the average annual accounting profit. Annual accounting profit. It measures the average annual accounting profit. Measure the average annual accounting profit generated by an investment. Accounting profit generated by an investment. 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 Generated by an investment relative to its average investment cost. 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 Next statement, it is expressed as a percentage. Is expressed as a percentage and help investors or managers and help investors or managers assess whether an investment is worth pursuing. Assess whether an investment is worth pursuing. Assess whether investment is worth pursuing based on its expected accounting profitability. Based on pursuing based on its expected accounting profitability. On its expected, based on its expected accounting profitability. So class, to get the ARR, we have like a formula. It's equal to average income divided by average investment. Average investment times 100. So how do we get average investment? Average income, sorry. How do we get average income? So average income is just given by summation of profit after tax of PAT, profit after tax PAT, divided by number of years. Number of years. So those are just the formulas. And then we can have, how do we get average investment? Average investment ka formula is equal to the average of balance brought down plus average of balance carried down divided by 2. Average of balance brought down plus average of balance carried down divided by 2. Right, but just finish up. Take your time. Finish up. The profit after tax part is profit after tax. Thank you. So Virginia, allow me to lower your hand ili usichoke sana. Allow me to lower your hand. Yeah, great. Usichoke sana. Good. Profit after tax is part. Profit after tax. Are you done? Once you're done, just confirm. And then we move to the illustration. Illustration. Say that a company is considering investing in a project whose cost is 10 million shilling. Company is considering investing in a project whose cost is 10 million shillings. Company is considering investing in a project whose cost is 10 billion shillings. It has economic life for 4 years. Straight and a scrap value of 2 million. Full stop. Depreciation is on a straight line basis. And tax has been charged at a rate of 30%. Per annum. Tax has been charged at a rate of 30% per annum. Tax has been charged at a rate of 30% per annum. Then we have sales for the first year has been expected to be 5 million. Sales for the first year has been expected to be 5 million. Increasing by 10% per annum thereafter. 10% annum thereafter. Increasing by 10% per annum thereafter. Average investment formula not visible. Sema kwamba it is just average investment, average of balance brought down, right? Very fast. Average of balance brought down plus average of balance carried down divided by 2. Yeah. Somebody can share a formula. Contribution is 80% of sale. Contribution is 80% of sales, and the fixed cost is 200,000. The fixed cost is 200,000 per annum. So required, determine the ARR. Determine the ARR. The ARR. Just finish. Once done, let us get the solution. You can just confirm. Once you're done, you can get the solution. So once done, just confirm by typing done, D4 done, 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 done. Then we will be able to get the solution. Two more. All right, good. Now, solution. So we shall just split it into two. First of all, let's get average income. Average income. So I just have to use what I have to get the average income class. So I have 4 years. The project is going for 4 years. 1, 2, 3, and 4. And my sharing can be 1,000. Just have your sharings in 1,000 like that. Like that. Sharings in 1,000 like that. Okay. This is sales. Year 1 sales outstood is 5,000 class. It is increasing by 10% every other year. What will be the sales for year 2? Please give me sales for year 2. 3, 4, and 3 and 4. Yeah. Give me the sales. Please give me the sales. You just increased by 10%. So year 2 sales will be 110% of what year 1 is. So 110% of what year 1 is. Or you find 10% of that you add to 5,000. Evo. No, increase. We are increasing the sales by 10%. 5,500. Thank you. Please give me the other one. Increase this one by 10%. Tukisonga tumalizane na sales. This is very simple. Once you understand it, mambo inakuwa sawa. 6,000. Are you sure? Now you are increasing 55. You are increasing 55. Ukienda hivyo, sasa uta increase 55. Unaenda increase that. 60, 50. Na ya mwisho 60, 50. Ya mwisho sasa. The last one 66, 55. Class, we are done. Shamaliza na hiyo, mambo inakuwa wagwan. Because I've been told that contribution is 80% of sales. So in this question, I don't have the variable cost. If I had the variable cost, I could just less the variable cost to get contribution. But if they've told me that contribution is 80% of sale, why can't I get the contribution client and then move with that? So what is the contribution for the first year? Contribution. At least 2 is a contribution, 80% of each sales there. The first year, and then we move to this end. What is 80% of that? 5,000. 80% ya 5K. 4K. Nipatie hiyo ingine ya 5K. Usonge hivyo. 80% ya each sales. Hapa. 44. Hapa. 4840 na tunamalizia na hiyo ya mwisho. Atie tu ya mwisho tukimalizia 5324. Thank you so much. Plus, once you have your contribution, what do we do to our contribution? Now I forget about sales. Sasa sitaki I'll not refer to sales now. I want now to work from contribution. Kama when you have the sales minus cost of sale, you get the gross profit. Your expenses are subtracted from the gross profit, not now from the sale there. Umeachana na say, because Gross profit is a product of sale minus. Yes, yes, yes. Are we together? Please confirm that we are together, that we are now just dealing with this from contribution. Confirm, 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 confirm. Okay, good. Tunasema kwamba, you see, if I have in my income statement, when preparing the income statement, you usually have sales at the top there, or revenue, right? Minus cost of sale, minus cost of sale. What do we get? Revenue minus cost of sale. Tunapata nini? Tunapata gross profit. Now, if I want to less my expenses, will I less my expenses starting from, will I take sale minus now expenses? Will I consider sales when lessing expenses, or I consider gross profit? I consider gross profit. That's what we are talking here. So gross profit kwa finance tunaita contribution kwa finance sasa, kwa finance tunaita contribution. So the moment now you have your revenue and you have contribution. Now contribution is the net. Now we use the contribution kama our gross profit. So any other item will be adjusted from the contribution. Sales tushamalizana nayo. The remaining part ya hapo ni variable cost. Hizo variable cost hizo zimebaki huko. Sawa sasa. Galaxy bwana, tunarudia tu saa hii ndio tunaongelelea. Galaxy wewe. Galaxy, hebu simama mahali huko halafu uketi. Hebu simama mahali huko halafu uketi. Galaxy contribution. So we just adjusting any other item down here using these values from contribution. Okay. Now class, what do we less here? We less fixed cost. From contribution, we less fixed cost, and our fixed cost is 200 all through. 200. So I'm just lessing the fixed cost. Na tapata my what? Earning before depreciation and tax. Earning before depreciation and tax. Galaxy 4,080%. Galaxy, ebu simama kwanza. Be genuine to us. Year 2 contribution. Year 2. 4,400. So Galaxy, 80% of 5,000 ni ngapi? And confirm kama umepata hiyo. Confirm kama umepata hiyo. Galaxy. Steras. Confirm kama umepata 80% of 55. Napatia 44. Sawa. Confirm kama umepata hiyo. Now this one will be 3,800. I'm just getting the earning. This is 4,200. 4640 and 5124. Those are our earnings. Thank you for confirming. Galaxy is still waiting. Miaka ni 4 sisi tuko na earnings miaka ni 4. 1 2 3 and 4 and our shillings are 1,000. Shillings are 1,000. Now at this point, we're going to look at we can less depreciation. Less depreciation. So class, what is the depreciation? Depreciation using the straight line method. Cost minus salvage divided by useful life. How much are you getting as the depreciation? How much are we using as the depreciation? Or how much shall we have? Cost me 10 million. So 10 minus salvage ama scrap value 2 divide by what? By 4. So it will be 10,000 minus 2,000 divided by 4. Depreciation unapata ngapi? Depreciation unapata ngapi? Depreciation unapata ngapi? Give me that. How much? 2000. Plus, hii 2000, help me understand. Is it accumulated depreciation or depreciation for the year? Is it accumulated depreciation or depreciation for the year? What is it? Is it accumulated or depreciation for the year? Just help me understand. So, when I talk about this depreciation class, nataka tuelewane hapa eh? In this year one, it is depreciation for the year. If I am to put year one eh? So kuna watu wanasema ni accumulated for the year, accumulated, kuna watu wanasema ni depreciation. So accumulated depreciation, sawa, ni sawa. But this one is cutting across. It's cutting across eh? Accumulated depreciation. It's cutting across. It's cutting across. It's cutting across. Tena niko na hii ingine. This one, the 10,000. If I take 10,000 minus this 2,000, hii depreciation bado itakuwa accumulated depreciation kweli? Sasa hiyo mwaka chukue 10,000 minus 2,000 itakuwa accumulated ama sasa depreciation for the year because it has reduced that cost. Will it be accumulated ama depreciation itself? Depreciation for the year. Depreciation for the year. Nikichukua hii sasa nataka kupata the net book value ya hii. So nitachukua hii minus hii nipate kitu kama 8,000. Itakuwa accumulated ama depreciation for the year. Now this one at this point ita act kama depreciation ya hiyo mwaka. Sasa ita act kama depreciation ya hiyo mwaka. So what I want to show you is that this our depreciation hapa, depreciation ndio itakuwa depreciation for the year na accumulated what? Accumulated depreciation. In fact, accumulated depreciation is the depreciation for the previous year brought down ama carried down. So if I look at this accumulated depreciation, nikuwe na another the same accumulated depreciation hapa. So this depreciation still will be the depreciation for the year. I'll show you when we shall be looking at what? The average investment. Average investment. Good. Let's get our earning before tax. The earning before tax ni gapi? 1800. Kwanza ni 18, 2200. Is it 22? Yeah. The other one is 2640. The other one ya mwisho ni hii ingine itakuwa ngapi? 40. 51, 24 minus 22,000 itakuwa ngapi? 3124. 124. 124. Class, let's tax is 30%. Tax is 30%. What is 30% of each? 30% ya kwanza, ya pili, ya tatu na ya nne. Ngapi ngapi? Pate ya kwanza, pili, ya tatu na ya nne. Before we go for a very very short break. 540. Anipatie hiyo ingine tukisonga. 660. Hiyo ingine 786 ama 720. 2640. 30% of that 720. Mbona watu wanapata tofauti? 720. Is it 720? Is it 720 ama 786? Ai, 792. Kwani watu wanatafuta ndo jamani. Sawa. Patie basi. 792. Mbona watu walikuwa wanapata tofauti? 792. Haya basi hiyo ingine 738. Na sasa basi ya mwisho 937.2. 937. Sometimes calculator zetu huwa zinaruka kidogo Haya basi tupate our earning after tax ama profit after tax. Earning after tax ama profit after tax. Earning after tax. Allow me to start just kidogo. Profit after tax ama earning after tax. So tunapata 1260. Hii ingine patie zote tukisonga sambia. Ya pili, ya tatu, ya nne tukimaliza 1540. Patie hiyo ingine. Ni the other 1848. Na ya mwisho, give me the last one. Give me the last one. Give me the last one. 2186.8. Class, let's get the average income. Average income, remember our goal was to get average income, which is given by the total easy divided by 4. Give me the average income. Napata ngapi? Kiongeza hizo zote, the 4 divided by 4. Hiyo ndio average income. How much? Pata ngapi? Pata 1708.7. Please confirm that we are together at that point. Yes, confirm. Be done with that part. Confirm that we are together. 1908.7. So hiyo ndio average. At least we've been able to get the average. Unaona hatuja discount mahali. This method ignore discounting. Ignore discounting the in fact we don't have the cash flow here. You don't go further and get the cash flow. Kwa inafika tu hapo kwa profit. Haya basi tupate average investment. Very simple. Average investment itakuwa very simple. Average investment. So the first thing is to have our years 1, 2, 3, and 4. Balance carry down. Shillings are 1,000 kama kawaida. Shillings are 1,000. So I have the balance that were brought down. Kuwa na 10,000. Ikipunguzwa na depreciation ya year kuwa 8. Ikipunguzwa inakuwa 6 na kuwa 4. Alafu tutoe nini? Depreciation yetu ya 2K throughout. So there was a coincidence of our depreciation ya year na hiyo yenye inapunguza accumulated. So balance carry down na kuwa difference ni 8, 6, 4 na 2. Use the formula to get the average investment. Unapata average za hii, unaongeza hizi zote alafu una divide na 4, then add average ya hii. Balance brought down na balance carried down. Please get the average investment. Get the average investment. You have already but in the balance brought down, yes, depreciation tumesema ni mbili, depreciation ni mbili. Kuna depreciation for the year na depreciation ya nini? So hapo tuelewane. Kuna depreciation for the year na kuna depreciation, accumulated depreciation na depreciation for the year. So hiyo ndio tumetoa. So accumulated depreciation, hii item inapungua kila mwaka na ilikuwa na accumulated yake. So balance brought down watu wanapata 7K. Balance brought down 7,000. Then you get the average year balance carried down. How did you determine it reduced by 2,000? Balance carried down, I'm going to look at that, is 5,000. When you add the two, you get 12,000. So that means average investment itakuwa average investment is equal to 12,000 divided by 2, which is 6,000. Now, I've seen a question from arrive at 8,000 for year 2. 8,000 for year 2. Yes. We usually have two types of depreciation. Depreciation. So at least we have been able to get that one. So depreciation ya kwanza ni depreciation for the year. Depreciation for the year. And depreciation ya pili ni accumulated depreciation. Good. And the time umepewa accumulated depreciation will always help you. Hata kwa accounting utaona. It will always help you to find depreciation for the year. Yes, depreciation for the year. Because you come up with your account. But now at this point, we don't need to come up with an account, right? So in this case, I just need to do what? I just need to check what was my accumulated depreciation. Accumulated depreciation. Hey, Marine, we are just trying to explain and now you're saying lost. If you don't focus, imagine you utapotea kabisa. Utapotea kabisa. You just get lost. So we are just trying to explain. And then somebody saying lost. That's what we are explaining here. So you just focus. So we are saying that we usually have two depreciations. The first one is depreciation for the year and accumulated depreciation. And in most cases, accumulated depreciation will help you to get the depreciation for the year. Depreciation for the year. First of all, confirm that you understand that we usually have two types of depreciation. Confirm. All those who are not getting the 700 imetoka wapi. Confirm that we have two types of depreciation, which is the one for the year, the other one is accumulated. Good. Now, accumulated depreciation is a depreciation that give us that was for the previous year, right? Hapana bwana, Gladys jameni. We are now tracing where it came from and still you are asking. But you, jameni, Gladys, please focus. So we are saying that we have a balance of depreciation for the previous year, and that is which will accumulate, and we have managed to compute 2,000. You have managed to get 2,000. You have managed to get 2,000. This depreciation, these 2,000. In this question, in this specific question, it is still the same. And I think I explained that, maybe it passed. It is the same depreciation that will affect our asset. It will affect our asset. But how does it now affect our asset? It will affect our asset after. We have already impacted our accumulated depreciation. So if I take cost minus this depreciation, 10,000 minus 2,000, how much am I getting? I'm getting 8,000. And that will be the remaining value. The remaining value of what? The remaining value of that asset. You to shatoa. Now, when it comes to the other part, because we don't want to know what will be now the balance after we subject these to our depreciation for the year. What will be the balance? It will be now this 10,000 minus now depreciation for. So we have two depreciations here, right? We have two depreciation. Moja ni accumulated, the other one is. But in this question, it came to be a coincidence that zote ni 2,000. Zote ni 2,000. I'll find a question whereby it may differ. It may differ that we have maybe a different accumulated depreciation and a different what? A different depreciation for the year. So always note that accumulated depreciation will help you to get or to arrive to depreciation for the year. If the rate is not given, but if the rate is given, it become very simple. Sasa wenye wanauliza 700 imepatikana aje? Please pick this one. As from the formula, you add all these, divide by 4. Hiyo ni ya kwanza, they brought down, divide by 4. Then, to get the second one, you add all these, divide by 4. Add all those, divide by 4. Tell me whether you're getting 7,000 and 5,000. Are you getting that? Please confirm. Those people who are not able to get that. The average of the balance brought down. Yes. Plus the average of the balance carried down. Aha. Confirm that you're able to get 7 and 5. 7 and 5. The average. I'll be able to find another question so that we compare. Are we able to get that? Confirm. So that we can move on. Okay. Now, let's get the ARR. ARR is average income, this one. 1708.7 divided by whatever that we got, 6,000 times 100. How much is that? How much is our ARR? To 2 decimal places. ARR to 2 decimal places. 2 decimal places. The 1708.7 divided by 6,000. 28.48%. 28.48%. Good. Now, after getting 28.48%, we are going to have the acceptance rule. How now do we give the opinion? How now do we decide? Give the decision. So you call it acceptance rule. You call it acceptance rule. So how do we give the decision now? The management will set the lower limit, the lower rate. So acceptance rule useme kwamba, and to say this, in accepting the project, the management has to set a minimum ARR. In accepting the project, the management has to set a minimum ARR. The management has to set a minimum ARR. So as when it falls above the rate, when it falls above the rate, we accept the project. When it falls above the rate, we accept the project. Full stop. The next one, you say that if it falls below the rate, we reject. If it falls below the rate, we reject the project. So assume maybe the management had set the rate to be 25%. Would you have accepted or rejected the project? Assume the management had set the rate at 25%. Would you have accepted the project or advised them to accept or to reject? Accept or reject. Kuna watu wanasema accept, kuna wengine wanasema reject. Nasema kwamba I'll just repeat that and say that in accepting the project, the management has to set a minimum, a minimum ARR. So as when it falls above the rate, ikiwa juu, above the rate, we accept. When it falls above the rate, we accept, and vice versa is true. When it falls below the rate, whatever that we compute, if it falls below the rate, we reject. So in our case, if whatever that the management has set is 25% and we have gotten 28%, therefore we need to do what? We need to accept the project. So management, you'll be told if the question comes, examiner atakwambia kama anataka advice. Yeah, if it falls, if you have maybe the minimum rate or as per the management as 25% in our question, that means we shall accept the project since the ARR is greater than the minimum set rate. Yeah, accept the project. Okay, class, I want us to have just a 5 minutes break. 5 minutes break, dakika tano. And when we come back, we are going to look at the modern technique or discounted technique, modern technique. So we shall be looking at the modern technique or discounted technique, modern technique. Discounted technique. We shall be able to look at that. So let's have a break of 5 minutes. Then we shall be back at exactly 6 o'clock. And the modern technique, we say that this one now consider the time value of money. It utilizes all the cash flow under consideration. So these methods we are going to discount. We are going to discount or to get the present value of the cash flows. We're going to discount. So they include, or maybe we can write just like this and say, they are called modern because they consider the time value of money. 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 They include the following. They include the following. They include the following. They include. They include 1, net present value. Number 2, the internal rate of return. Internal rate of return. So net present value, NPV, IRR. Then number 3, we are having number 3, which is the profitability index or discounted payback period. Discounted payback period. Then we have number 4, which is profitability index. PI, profitability index. Number 5, we have quote of the illustration with the difference depreciation. Depreciation. Gary, that one we shall look at it later. In fact, that question is not that common. That's why even I searched on that illustration that we've just done. tutaiangalia. Then we have the other one, which is the last one, which is the modified internal rate of return. Internal rate of return. MIRR. Modified internal rate of return. Modified internal rate of return. So those are some of the methods that we have under the modern technique. And we start with the first one, which is the net present value. Let's start with the net present value. Net present value. So we saw that it tries to consider the difference between present value of cash inflow. It tries to consider the difference. Tries to consider the difference between the present value of cash inflow, between the present value of cash inflow and cash outflow. Present value of cash inflow and cash outflow. So formula for getting NPV. Is given by this one. NPV is equal to present value of cash inflow minus present value of cash outflow. Cash inflow minus that one. So class, you see that categories of cash flows under this, categories of cash flow under NPV. Categories of cash flow. Tuko na ya kwanza, which is initial outlay. This is the initial cost incurred. Initial cost incurred at the start of the project. Initial cost incurred. Number two, we have annual net cash flow. Annual net cash flow. Annual net cash flow, or sometimes after tax cash flow. Tax cash flow. These are the returns we get from the projects. They are like the returns, the cash inflows that the project give us. Then we have terminal cash flow. Terminal cash flow. So terminal, as the name suggests, terminal, it is the cash flow obtained on the termination of the project. Cash flow obtained on the termination. On the termination of the project. The termination of the project. So we're going to look at the format to get, how to get initial outlay, how to get annual net cash flow, and how to get terminal cash flow. Please confirm once you're done with the three. Once you're done with the three, just confirm so that we are able to have the format for the three. So how do we get initial outlay or incremental initial outlay. So we have two methods, or we have two ways. Incremental initial outlay. Initial outlay. So maybe one for general purchase of machine. General purchase of a machine. So if the company just want to purchase the machine, how do we get the initial outlay of such? We look at the cost of the machine. Thus, you add incidental cost. Incidental cost. Incidental cost, comma, transportation cost. Kama kuna import duty. Kama kuna installation. All those costs that are used to make sure that this item is put into use. All those add up to giving us now the depreciable cost. So if I want to depreciate this machine, nitatumia hiyo. Tumia hii. Muhimu sana. I will not depreciate using this cost. So I add any other incidental cost. Class, what are incidental costs? These are costs incurred on this machine until it is put into use. If I'm talking about portion mill, and this portion mill is being transported to Western, there's what I'm going to pay the seller. That is the cost. Maybe the seller is selling 200,000. So I give to the seller, hiyo ni cost done already. Hiyo ndio nimepeana. But still, is it possible for me to just use that portion mill there where I've bought it? No, it is not possible. I have to incur other cost. And that is what we call the incidental cost. Cost of transportation of this portion mill from Nairobi to Western Busia huko. That cost is an incidental cost. Bado hiyo kisiagi haiwezi tumika imefika sawa. After that, I need to do installation and also repair. Mali una repair, assembly. There's some parts that you need to assemble. Haiwezi enda kama ikiwa yote. So you assemble. The cost that you use to assemble, to install, still you add it there. Once you install, you connect the electricity until now you start operating that kisiagi. At that point, we say that you have all the cost at price. Yeah, insurance still will be part of that. But any cost that is not part of whatever that you paid to the seller, any cost until you put that item into use, right? Now, when we add all those, we shall be getting the depreciable cost. That's now the total cost of that item, that asset. And if I want to get the depreciation, this is the value that I use, not this one. So hapo ushike vizuri, not that one. Then you come and add investment in working capital, if any, investment in working capital. How do we get investment in working capital? That one you add. Then you add present value of overhaul cost. Present value of overhaul cost. Now, class, we need to maybe define what is this overhaul. What is overhaul cost? What is overhaul cost? Overhaul cost refers to the cost incurred to replace a certain part of that item. Maybe let's say the useful life of that portion mill is 5 years. But at the end of that year, one of the parts was broken down, or it break. We are going to replace. That cost of replacing is what we refer to as overhaul cost. and you must find the present value of that what? Of that cost. If it was 100,000, and the rate was 10%, I have to just multiply by 1.1 raised to negative, imebreak kwa mwaka wa tatu at the end of the third year. This will now be the present value. I record it there. And then this one will be able to give me the what? The total initial outlay. Total initial outlay. Hiyo ni just a general one whereby we are just purchasing what? Where we are purchasing that. Okay. Yeah, somebody saying that pardon on the overhaul cost. Overhaul cost is the cost incurred. It is the cost incurred to replace a certain part of that machine. To replace a certain part of that machine. That is what we refer to as the overhaul cost. So you'll be able to check on that. Now, class, under replacement, how do we get initial outlay if we are replacing existing machine? If we want to replace the existing machine, how do we do that? How do we get the initial outlay? If we want to replace the existing machine, the initial outlay itakaaje? Under replacement. Initial outlay under replacement. So under replacement, initial outlay will be given by these one shillings, like that. So I have the cost of the new machine. Sasa unaona hapa I'm very specific. Lazima niseme new, niweke pale. Add incidental cost. Kama ziko weki incidental cost. I'll just mention a few: transportation or transport cost, installation. All those kama iko naongeza pale ili tupate our depreciable cost. So if I want to get the depreciation of the new machine, this is what I use. Depreciable cost natumia hiyo. Then class, if I want to replace my phone, with a new one, what I do is to sell, to dispose the one I have yenye nataka ku replace. If I want to buy a phone worth 50,000, I will sell the one I have. Maybe assume the value of that phone. The one I have is maybe 20,000. Ninauza hiyo simu 20,000. How much will I be required to top up to buy a new or to acquire a new one? Nimeuza yenye niko nayo 20. How much will I be required to top up? I'll be required to top up 30,000. So that's the amount to 50,000. The same case applies to this one. When the company is replacing an existing machine, it disposes that machine. Therefore, the value of that, the disposal value of that machine will be used to buy the new one. So we less the disposal value. Hapo uelewe vizuri. Hiyo value tunatoa. Less the disposal value. So hiyo pesa yenye tumeuza the existing itatumika kununua the new one. You understand? Then we look at now the taxman. Tukileta disposal, taxman wanakuja. So we think about the tax thing. The effect, we look at the effect of tax. Effect of tax on gain or loss. Gain or loss on disposal. So hapo sasa we think about, yes, mnauza assets. Lazima we think about tax. So there will be the disposal value. We compare with the net book value. Disposal value hapo, compare with the net book value. Class, if the disposal value is greater than the net book value, shall we get a gain or a loss? If the disposal value is greater than the net book value, shall we get a gain? Does it give us a gain or a loss? If the disposal value, yeah, exactly, is a gain, right? what will be the effect of that gain? Of course, we subject that gain to tax. So hapa nitakuja niseme nitapata either gain ama loss. So it's either the two. So you subject to tax. Subject to tax. Kama umepewa 30%, you subject to 30%. So that gain, kama ni 50, admin, which one do you think unasema haita happen? You know, we are considering the existing machine, even the net book value near your existing machine. You will be able to see it can happen. It can happen. It can happen vizuri sana. Existing machine una value. Gain on disposal, yeah, and also loss on disposal. So, well, if it's a gain of 50, and our tax rate is 30%, how much are we going to record as a gain? How much are we going to record as a gain? We are following. Kama gain ni 50, cost 50 million ama 1,000. How much are we going to record as a gain? It is 30% of 15. 30% of 50. What have you written? After net book value. After net book value, allow me to just repeat it here. After net book value, niko na subject to tax. Subject to tax. This is either a gain or the loss. Either gain or the loss, you subject to tax. Alafu hapa ukuje uweke gain or loss. So the gain increases our cost and the loss reduces what? Reduces the cost. Remember, in your account here, cost. In your account here, cost. Gain, it increase the cost, and that way. Then you come and add investment in working capital. Investment in working capital. Working capital. How do we get working capital? Current asset minus current liability. Vizuri kujua. Unaongeza pale. Kama kuna overhaul pia, naweka pale. Then you get your total initial outlay. So initial outlay. So we will be able to check that. Be able to check that. Be able to check that. Allow us to look at the next one. Allow us to look at the next one, which is incremental annual net cash flow. Number 2, incremental. Sasa hii machine itatuletea nini? Annual net cash flow inatuletea nini? So assume the machine has got a useful life of 4 years. Useful life of 4 years. Has got useful life of 4 years. Na hii miaka 4, we are having the revenue. The higher the examiner anaenda kupatia. Revenue cost minus less variable cost. Minus variable cost. Revenue minus variable cost. We are having the contribution hapa. Contribution. Cost after contribution kama kawaida, we less fixed cost. Fixed cost. So less fixed cost like that, mambo inakuwa warrant kabisa. Napata you are earning before depreciation and tax. Yaani hii ukishashika mambo inakuwa mzuri zaidi. Hii ni process tu mzuri ukishaishika vizuri. Now class, tukifika hapa, we can either use the add DTS method or we can use the add back depreciation. So hapa juu wacha tutumie hii njia ya add DTS. Add DTS. I'll be able to tell you what is DTS. Add DTS. Tuseme hiyo ni method ya add DTS. So if I'm using this method, this is variable cost. variable cost. So I less tax kwanza, kama nataka kutumia hii method. Less tax. Tax yetu tunatoa pale. Less tax like that. And then add DTS. Add DTS. I'll be able to tell you what is DTS and how to compute it. Once you do that, at least you will get now the annual net cash flow or discountable cash flow. Let me just put it here. After adding DTS, napata annual net cash flow. Cash flow that I can be able to discount. Remember this time round, sasa discounting ni key. So year 1 to 4. Year 1, 2, 3, and 4. So hapa sasa niko na annual net cash flow. The cash flow that I can be able to discount. And then I discount using the rate given, discount. And then I get the discounted cash flow. I'm a present values. Like that. So hizo tutazifanya practically. So hiyo ni hiyo method. So DTS refer to depreciation tax shield. Depreciation tax shield. Depreciation tax shield. Hiyo ni DTS. How do we get DTS? Is equal to depreciation. Hiyo ni ka formula na wapea. Depreciation times tax rate. So tukishapata hiyo, mambo inakuwa warrant kabisa. Depreciation times tax rate. That's how we get. Finish up. Malizia. Ogaro, malizia. Tumalizie and you ask a question. Just finish. Mary was disconnected. Where should I pardon? At which point? Mary? At which point? From okay. Okay. First of all, umemaliza kuandika chenye iko hapo? In the first case. Have you finished to write that? Not yet. Haya, malizia. Once you're done, let me know. Once you're done, let me know. Once you're done, you can just confirm. Go all the way to having the DTS formula. Are we done? So once you're done, you're just putting D for done, so that we can be able to elaborate. Can be able to elaborate once you're done. Just indicate D for done. Then we will be able to. Okay, great. Working capital, yeah, thank you. Good. Now bring the question. I can see some of the question or most of the question has been answered. What does WC stand for? Working capital. Na tumesema working capital is given by total assets or in fact you can say total asset minus current liability. Alafu sasa tuko na, in fact that's correct GK. Kuna mwingine ameuliza ati sijui ameipata wapi. It is annual net cash flow, right? Annual net cash flow. The ANCF, annual net cash flow, whatever you are looking at. Then you discount. You'll be given the rate. Remember, we shall be doing this practically. Ask another question now. Ask another question from what you can see. Ask another question. EBDT, that one we've been using it. Earning before depreciation and tax. DTS tumesema ni depreciation tax shield, and we've given the formula on how to arrive to that. Ask a question. Ama sasa tuko pamoja. Are we together now? Up to that point? Hope your time imetosha. Are we together? I want to go to the other approach whereby we add back DTS. Add back depreciation, not DTS. First of all, confirm that we are together so that we can move to that one. Are we together? What does contribution mean? Hey, Maria, contribution ni ile tu tulikuwa nayo. Na nikaelezea kwamba hii ni kama gross profits. I don't know whether ulikuwa umejoin at that time. Contribution ni ile tu. It's like our gross profit. It's like our gross profits. Haya, sawa. So the other method, it is the add back depreciation. Andika hapo juu. Add back depreciation, of course, determining the annual net cash flow using add back depreciation. So we want to use the easy abbreviation can become, no, they are very good. In fact, they are very nice. Kuliko kuweka jina yote. Hata hatutaweza ku-input the figures. Hata kwa mtihani weka tu hivyo. Nakuwa sawa. Good. I hope you've written that. You're using the add back depreciation. And user, you need to put your name. User, kindly put your name. Yeah. Yeah, user. It's okay. That is very okay. That's very okay. Now, I hope you've written the add back depreciation, incremental annual cash flow, or use to get incremental annual net cash flow. Class, you just repeat. This will be the same. This up to here, up to the earning, up to here. So repeat here up to here. Once you are done, once you umefika earning before depreciation and tax, just confirm, signal once you're done. So tunaenda kwa hiyo method ingine ya kutafuta the annual net cash flow. Hiyo ni method ya kwanza. So we are now at add back depreciation method. Add back depreciation method. Add back depreciation method. Ukifika hapa kwa earning before depreciation and tax, confirm, just signal, just give a signal. Ukifika hapo, just signal that we're able to conclude. Fika hapa hivi. Are you done? Are you done? Are you done? Good. Now, ukishafika hapa sasa ukitumia the add back. Hii ni add back depreciation method. Add back depreciation. Still computing the same thing, right? We less depreciation kwanza. Less depreciation like that. Like that. Shatoa depreciation, utapata something like earning after before tax. Earning before tax. Earning before tax. Shapata hiyo, nakuja hapa una less tax. Mwaka ni 1, 2, 3, 4. Less tax. Less tax. Kisha less tax yako hapa. Add back depreciation, less depreciation, then unapata earning before tax, then you less tax, unapata earning after tax. Earning after tax. Ili upate cash flow, hapa ndio huu unakuja unaandika nini? Unaandika the add back depreciation. FC ni fixed cost, somebody asking. FC ni fixed cost, sio finance cost, ni fixed cost. Fixed cost. Okay, then we have our annual net cash flow. So hii njia inakuwaga mrefu, then you discount, then you get your discounted cash flow. Discounted cash flow, uko umemaliza. Depreciation not less. So Merin is asking, we are adding depreciation. First of all, tulitoa. First of all, we subtracted. Sawa. First of all, less depreciation kwanza, and that is the difference between this method and the other one. We started by lessing tax in the other one. This one we are lessing depreciation kwanza. Subtract, then add. Exactly. Yeah, you subtract kwanza, then you add. Add. Oh, hapa. Thank you. So I've just put this should be add. Yeah. This is now add. The same depreciation yenye ilikuwa pale, unakuja unaongeza. Thank you. This is that was a mistake. Yeah. You just you add back that way. That was just a mistake, Maria. That was just a mistake. Just finish up that one. Just finish up. Once you are through, confirm that you are through. Ukimaliza, just confirm. Are you done? Okay. Then finally, number 3, method 3. Ya mwisho sasa ni hiyo ya kupata terminal cash flow. Ya 3. Terminal cash flow. So how do we get terminal cash flow, class? Uongo. Uongo. Penea, uongo. Na venye nimepatia time. Good. Terminal cash flow. Terminal cash flow. Focus. Terminal cash flow. We have the salvage value of the new machine. Salvage value of new machine. New machine. Salvage value of the new machine. You less, I'll just write it there. Salvage value of the new machine. You less salvage value of the older, existing. You less salvage value of existing. Salvage value of existing machine. Less salvage value of existing. Existing. You less that one. Then you add investment in working capital. In working capital. You add investment in working capital and you'll be able to get your, in fact, you get a figure here and this figure you need to discount. Discount. You need to get the present value of that figure. That figure, you discount. Upeweka tu hivyo, you'll be able to see when we shall be doing a question. So you discount that figure. Class, which discounting factor or which year discounting factor should be used to discount this cash flow? To discount hiyo. Tutatumia gani? Tumia mwaka gani? In our case tulikuwa na miaka 4 hapa. Tumia which year factor? Which year factor? Just think about it. Which year factor should we use? Which year factor should we use? The 4th year, the last year. Thank you. It is terminal. It is cash flow that this company will be getting, cash inflow that the company will be getting at the end of the useful life. So the last year. So ndio hii yenye utakuwa umepata hapa. Unaona hii? Hiyo ndio unatumia pale ku discount. You just multiply by what you get. Yeah. 4. Yeah, 4. Thank you. Great. That's great. Good. Finally, the same question that we have done about the one that you did about the payback period. It has got NPV concept. You are to analyze or to rank the project using NPV. Rank project using NPV. Using NPV. And we had 4 projects, of course. We had 4 projects. It is May 2016. Question number 1. B Roman 2. Now at this point, the first one, we had 1, 2, 3. Cash flow zake, we had 500,000. We had 0. So I can use PV. What was the rate? Just check from the question. What was the rate? Remember, we are now to rank using that. I am discounting this using the net present value. Sasa, rate ilikuwa gapi? Is it 15%? Just check. Rate ilikuwa ngapi pale? 15%. So PV 15%. So 1 plus R ndio formula raised to negative n. So what is 1.15 raised to negative whatever? Negative 1. 0.what? Nipatie ya kwanza, ya pili, ya tatu. Nipatie tu faster so that at least tufanye hata projects mbili. Hii ni project A. Hii ni A. Nipatie ya kwanza 0.24 decimal places. 86. Patie ingine tafadhali. Patie hiyo ingine ili kupata discounted cash flow yangu hapa. I'm just training you how to get the NPV faster. Easy fupi. Before tuende kwa swali hii ya 14 marks. Hii ingine hiyo yenye tumefanya ni marks mzuri. 86.95. You round it off, Caroline, you round it off. 75, 61. Na ya mwisho in fact it will be a 0, something at the end tupatia 0. Ya mwisho sinipatia 70. Ya mwisho hii ya 3. Mwaka wa 3 unajua itakuwa 0 kule mwisho, but give me the rate, the factor. Give me the factor for the last one. Or before then basi nipatie 5,000 times this one ni ngapi? 6575. Haya, tupate discounted cash flow yetu. Tuko project A. Patie ya kwanza. Patie ya kwanza tafadhali, na ya pili. Ya kwanza na ya pili. Ya kwanza na ya pili. You just multiply 500,000 times that. Nipatie as a whole number. Sinipatie point. Sinipatie point hapa. This times this. As a whole number. 368,050. Are you sure? Are you sure? Corona nimechapa vizuri hiyo hesabu. 434,800. 434,800. 434,800. Na hii ingine ya pili. Ya pili tupate ya pili. Ya pili tukipata tukisonga. We need to finish up. We need to finish up. Nataka kwenda project B. 370,850. 370,850. So class, tuongeze hizi. What is the total present value? Present value yetu. Ongeza present value ili nipate NPV. NPV is equal to total present value minus initial outlay. Minus initial outlay. Ukiongeza hizo mbili, pata ngapi? Ongeza hizo mbili. 812,850. 812,850. So initial outlay ilikuwa 1,000,000. So nikichukua 812,850 natoa 1,000,000. Hii ni negative. Hii project sio mzuri. Hii project sio mzuri. Patie hiyo negative. How much are you getting? Ili niende project B. How much are you getting? Mpaka niende B alafu mtafanya C na D. C na D nitawachia. C na D nitawachia. So naenda B. So give me that. So here 1, 2, 3. I have 0. 650. 850. Then I have PBIF 15%. Inabaki kuwa 0.8696, 0.7561, 0.6575. Alafu nipate discounted cash flow. Kwani tunapata negative ya ngapi? 187,150. Hiyo ni poor project. 187,150. By the way, ukiangalia sasa hiyo project yetu, kulingana na NPV, this is not a good project. It's not a viable project. But payback period ili rank hii project namba ngapi? Just check. It was ranked namba ngapi? Angalia tu peruse back. Payback period. Rank this project namba ngapi? Ili rank hii project namba ngapi? Yeah. That's why we say payback period is not the best. It is not the best appraisal technique. It is not the best. This project cannot give us anything. Good. Let's go to project B. Tuone. Anapatia hii ni sufuri. This one, 650 times this one. Winding it up. 491,465. 491,465. Patia ya mwisho. Ya mwisho this one. 850. Hiyo ni 850. Times that. 558,875. 558,875. Ongeza hizo mbili. Ongeza hizo mbili. Ongeza hizo mbili. Total. 1050,340. 1050,340. At least this is making some sense. I get the NPV, which is 1050,340 minus 1,000,000. At least I'm able to have something hapa. Mambo iko sawa. 340. That is at least positive NPV. 5340. Please do that of project C, project C, and project D. Then rank. Ranking tulisema unaiarrange vizuri. Then you rank. Tunakuja hapo unaweka project yako. Usiweke A wachana nayo. Andika NPV yenye umepata. Then rank. Rank them. Patia project kulingana na. The higher the NPV. Yeah, they are irregular. That's why we are discounting using the PVF. PVF 15%. They are irregular. They are irregular. That's very okay. So utakuwa na BC na D. NPV zako pale. Alafu you'll be able to rank the project. D, we are irregular. That's why we are using PVF. Hatutumii PVF, we're using PVF. Yeah. All right. Kindly go and finish that. And then next time we meet, we shall be able to do some questions that will give you like 14 marks, 15, 8 marks, 10 marks, like that. Hizo mrefu tukitumia hizo formula. So kindly go and just peruse through the formulas, just study those formulas vizuri, ziangalie tu vizuri, just understand them, and we will be able to check. So as for now, allow us to end at that point. Asanteni sana.